Hey guys, in this video or tutorial, whatever you want to call it, I'm going to be going over a beginner's guide to options. We're going to be talking about how to buy calls, how to, buy puts. We're going to go over everything you need to know as a beginner just to give you a little good start to your journey of trading options. Now, before we get into this video, however, I would like to give you a warning. Options involve much more risk than trading normal shares of a stock. So do not trade them if you are not 100% comfortable. It is not a guarantee that you will make money, and there is a possibility that you could lose a lot with the money that you have. So guys, if you're not 100% comfortable, please do not trade options yet. The first thing we're going to go over is something simple. We're just going to ask the basic question, what are options? So an option contract is a contract that gives you the right but not the obligation to buy or sell 100 shares of the underlying asset at a specific price, known as a strike price, on or before a certain date, known as the expiration date. Now, I know this is a lot to take in, right? But we're going to break this down. We're going to talk about the strike price. We're going to talk about the expiration. But this is the basic definition of an option contract. You can buy this contract. You don't have to exercise it. That's why it says it gives you the obligation. We're going to talk about how you buy these contracts, and I'm going to show you examples on Robinhood. So let's get into the first thing that we need to talk about. So there are two specific types of options. There are calls, which is a bullish bet. You are hoping that the stock goes up. Now I'm going to share a screenshot on the screen right now. It's going to show a call. It's going to show you what it looks like on Robinhood. So this contract gives you the right to buy 100 shares at the strike price if it is in the money, which we will talk about and help you understand later what those definitions are. But right now we're just getting over what a call and put is. So a put is the exact opposite. I'm going to show a put on the screen as well, just to give you an example of what it's like. A put is a bearish bet. You want the stock to go down. It gives you the right to sell 100 shares at the strike price. It is just like shorting a stock, right? So the further it goes down, the more you make because you're selling it at a lower price than when you bought it at, causing you to profit the difference between what you bought it at. Now, however, this only applies to if you want to exercise the contract. For both calls and puts, you can buy and sell something called premium and make money that way, which we will go over. So premium is the price you pay for the option contracts. Now, I'm going to share a screenshot on the screen as well of showing the premium. So as you can see on Robinhood, the prices to the right, you notice, for example, this is actually Apple. You notice that we have all of these numbers on the right. You see that the 134 call is $150 or $1.50. You see the one below that is $1.88. You see the one below that is $2.36. You see the one below that is $2.90, and so on. So that's the premium. That's what you pay in order to buy these contracts. Now, we're about to get in once we talk about the premium, what the 134, what the 133 is. But let's talk about what the premium is first. So as you can see, option premium is the price you pay up front for the contract. This price is calculated based off of extrinsic or time value for out of the money contracts and both intrinsic and extrinsic value for in the money options. Now we're going to go over what this extrinsic and intrinsic value is, but for now I'll just give you the definition of what the option premium is. So you will notice that an option premium will be worth more the closer you get to in the money options and also the further expiration because of implied volatility. So I'm going to show you a screenshot now to show you that you see how it says 131 call, 130 call, 129 call. You notice that it has this line above it. That means that it's in the money because Apple is already at 131. You see the Apple share price right now at the time of this video is 131.76. So when you're in the money, that means the underlying stock, asset, whatever it may be, is already at or above that level. So that's how you know that's in the money. When we say out of the money, that means that everything above that is out of the money because the stock hasn't got to that price yet. So you see 132, 133, 134, all of that is out of the money because the stock hasn't gotten to that price yet. And you see, the further we go out, the cheaper it goes. You see the 132 call is 236. You see the 133 call is 188, and so forth and so on. It gets cheaper and cheaper the more you go out. Now, as you see, the more you go down, so the 131 call is 290. The 130 call is 348. So the further you go down in the money, the more expensive it is because the stock price is already at that. Now, you might notice that I said 150, and on the screen it says, $1.50. Well, you times it by 100 because there's 100 shares, as we talked about before. Now, I'm going to show you another screenshot of the January 22nd expiration. You saw at the top of the first screenshot that we were on the January 15th. Well, now those same contracts for the same strike prices is worth way more because we now have time on them. Now we have time for those contracts to get to maturity. We're going to go more into this, but this is just a basic understanding for you guys. So, if the underlying stock is not at your strike price on your expiration date, then it will expire worthless and you will lose all your premium spent while not being able to exercise your contract. So you can sell these contracts before expiration and make money by the premium being higher than what you originally paid for it. So let's go through this scenario right now, guys. So let's say you buy, the 131 strike price at, whatever price it may be when Apple's at, let's say 131.76. Well, let's say you bought the premium for the January 15th, so it's 290. Let's say that on Monday or Tuesday, whatever day it may be, that Apple goes up to 135. Well, now that premium is going to be worth a lot more than 290. You can sell that contract and then profit off of the premium. So you never have to exercise a contract. You can make, all of your money basically just buying and selling premium. That's what I do, but you still have the right to exercise it if it gets to that date and it's still in the money. And you can even exercise it before then. You don't have to wait to expiration if you want to. But most times, what a lot of people do is because it gets expensive to exercise the 100 shares, they just go ahead and buy and sell premium. So now we're going to talk about extrinsic versus intrinsic value. So this is what the premium is made up of. This is how the premium is calculated. There's a whole formula, but we're just going to go over, the basics of what it's made up of. So intrinsic value only applies to in the money options because it is the profit you make when you exercise the option, and you can only do it if the stock is at that strike price. Therefore, out of the money options do not have this. So let's take a look at Apple again. Let's take a look at the same expiration date. Now let's take a look at the 131 call. Right? So right now, Apple is at 131.76. So the intrinsic value, how you calculate this is you minus 131.76 from 131. So you have an intrinsic value of 76 cents per share. So you'll make 76 cents per share because right now Apple's at 131.76. If you exercise it right now, you have the right to own Apple at 131. So you'll profit 76 cents per share. So let's do quick math on that. 76 cents times 100. So that would be $76. So now, in order to find the extrinsic value, it's whatever left is over. So you would do $290 minus $76, and that would come out to be $214. So you have $76 of intrinsic value and the rest extrinsic. So the reason, or how you calculate extrinsic value, like I said, is what's left over after the intrinsic value. And the extrinsic value is made up of time to maturity plus implied volatility. So the more time you have to maturity, so the farther out expiration dates you go. So let's say we go to January 29th. The contracts are going to cost a lot more than the January 15th because we have more time for that contract to actually get to that strike price. January 15th, we don't have a lot of time for Apple to get to 133, but you notice at the January 29th expiration date, it's a lot more expensive because we have 2 more weeks for it to get to that. So that also is why further out contracts cost more. And the other thing, which is factored into it, is something called implied volatility. So this is how volatile a stock is. And the way you check this is you go to the stock you want to, click on it, and then once you click on it, then you can, with the stock option, you click on it, and then you can pull up these stats. So you can see where it says volume, open interest, implied volatility, and all that. So the more volatile a stock is, you see on this particular contract at 132, for Apple 115, it is 32%. So that's implied volatility for that contract, or Apple in general. Every stock's going to have a different implied volatility. Tesla, if you notice how expensive Tesla contracts are. So let's look at a Tesla contract. We're going to pull up a Tesla contract, and we're going to go to the same January 15th. We're going to go to the 870 call and look at the implied volatility on this. This is 79% implied volatility. So you can see they're a lot more expensive. 870 call is $4,000, right? So implied volatility, and also factor in how much the stock price costs. Tesla's $800, Apple's $131, but the main thing is the implied volatility. If it's a lot higher, then that contract's gonna be a lot more expensive, because it can go a lot more up or a lot more down for that range. So that's something to take in factor. And also something you need to take in factor is that these contracts, the extrinsic value, their whole goal is to decay it, and once it gets to expiration date, it's either going to be worthless or it's going to be in the money. So it's going to lose value every single day if it doesn't push up. And then we're going to talk about more about this. We're going to talk about the Greeks and how you can see this decay, but just know the whole goal for the extrinsic value is to decay every single day. The more you hold that contract, if it doesn't go up, the more value it will lose. So now we're going to go over the strike prices. Now we briefly touched this, so let's go over this once again. So we're going to look at AMD. We're going to change it up. We're going to look at their contracts. So let's look at the January 22nd contract. So we're going to go over these definitions. So the strike price is the price you want the stock to go by the specific expiration date. So for January 22nd, let's say we choose the 95 call. So by January 22nd, if you want to exercise this option, you want AMD to be at 95 or above. The more above it is over $95, the more it'll be worth. Now, you don't have to exercise these contracts. As I mentioned before, you can just make all of your profit selling the premium. So obviously, if AMD is way above $95 by January 22nd, your premium, the $315, is going to be worth a lot more. So keep that in mind as well. Now, we're going to go over some definitions like we did before. We already briefly went over this. In the money, we talked about the stock is already at that price. At the money means the stock is right at that strike. So $95, would be considered at the money. Out of the money is that it means that it's not right at that price. So those are the three definitions you need to know. We already went over that, but those are the ones you need to know. So now we're going to go over something very, very important, and you really need to know this if you're getting into options. You have to get this down. So for this, we'll still go over AMD. We'll look at the 95 call, and then we'll look at something called the Greeks. This is very important, guys. So we're going to go over, each one. So Delta. So what is Delta? For this AMD contract, for the 95 strike, for the 122 expiration date, you see that Delta says 0.49. So since there's 100 shares, you times that by 100, so that's 49. Now, Delta is how much the contract moves up per dollar the underlying stock moves. So every dollar AMD pushes up, this contract is going to be making $49. So that's what Delta is. If you're looking at your contracts, the higher the Delta is, the better you are off, because it moves up more. And you'll notice the further you get in the money, the more the Delta goes up. So that was a 95 call. Well, let's take a look at what the 94 call is going to look. That's in the money. So the 94 call, it's $54. So guys, you can see the big difference of choosing in the money options. The Deltas, they're going to move a lot more as the stock price goes up. So that's also another benefit of buying in the money. That's why they're more expensive, so you are paying for that more premium, but they move a lot higher. Now, the second one that we're going to look at, still on the 95 strike price, is going to be at the gamma. It's how much Delta changes per dollar the underlying moves. So for this gamma, the 95 strike, it's going to gain $4 of Delta every dollar AMD pushes up. So if AMD moves up a dollar, then the Delta is going to change to $53. Now the next one, the final one we're going to look at is theta. Theta is the really important one. This is the time decay one that I was talking about before. This is what basically your contract loses every day. So for the 95 strike, you see that it says minus 11 cent or $11 because he times it by 100. So every day, no matter what, guys, it will lose $11 worth of value. So that's why it's important that if you want, less theta, you get further out expirations. Now the next one we're going to look at is Vega. This is how much the contract moves per 1% in volatility. The Vega, this is something you need to look at when there's a high earnings, a high volatile event such as earnings is coming up. So Vega is going to be up high during earnings play, and maybe it may be an event play. So that's something you need to look at if you want to see volatility. Now Rho, it's not very important, guys. This hardly ever is anything. Trust me, this is something you'll never use. But we're still going to look at Rho is how much the contract moves based off of interest rates. So guys, that was the Greeks. This is the end of the beginner's guide to options. I hope this helped you out. This was just a brief overview. If you need any help, just ask me. I'll be more than happy to answer your questions. But this was just a brief guide to options. I hope this helped you understand what they are and how to trade them. Either way, guys, be careful with them and study up on them. And overall, just make sure you're comfortable before you actually start trading them.